Welcome to It's the Economy. The Nifty hit its all-time high a month ago on July 20th and has since seen a slow downward drift. Its fall is coinciding with the rise in the US 10-year yield, which rose from 3.7% in mid-July, July 20th, to 4.3% currently. Are US yields likely to remain high and prove a drag for equities world over? What about counter trends, at least for India, like economic growth and earnings growth that can lift the Nifty? For a discussion on macros and micros, I have with me Vetri Subramaniam, Chief Investment Officer at UTI AMC. Vetri, good morning and thank you very much indeed for joining us. That really is the first question. It is the global discount rate, the US 10-year. So, first of all, do you see its ascent as something which is here for good? We should not expect a below 4% yields. In fact, be prepared for closer to 5% yields.
I think there is reason to believe, Latha, that there's a little bit of a regime change underway. And I think what's happened is that while we've all been focusing on one element, which is what will the Fed do to fight inflation in the US, they've obviously responded by taking rates up quite significantly. But I think what we are increasingly now grappling with is the fact that the same country, which for many years, used to always talk about being fiscally disciplined, though you could argue that they've never been as fiscally disciplined as their words were, seems to have now decided that this is actually a policy mix that is working quite well for them, which is to say they are trying to tackle inflation with higher rates. It's not causing pain in the economy in terms of job losses. It's not causing pain in the economy in terms of going into a recession. And at the same time, they've now discovered that they can keep the fiscal deficit, significantly higher than where it used to be pre-pandemic to sort of make sure that they are able to take care both of the, certain sections of the economy, as well as take care of the political economy mix. So I think what we are seeing is a regime in which monetary policy stays tight, but the fisc is used to support certain sections of the US economy, which, from a political economy perspective, maybe that's what the policymakers over there want to do. And I think that then completely changes the thought process about, where that long-term yield, which eventually settled down. I think, if the US government stays on the current trajectory, which is what the CBO forecasts are, then it's very hard to see their issuances come down and therefore very hard to see the long-term rate come down very significantly. Okay.
Now, if you can parse for us the impact on Indian and global equities. Actually, coinciding with this rise in US yields, we will just run the FII numbers for you. What was positive through June and July actually started turning negative. So do you think that equities get impacted, Indian equities? If yes, how much?
Sure. Yeah, it's a little bit hard to draw a one-on-one correlation, and I would be a little careful in doing that because I think eventually, no doubt the US is sort of the Pied Piper in terms of its monetary policy and the impact it has on all economies. But at the same time, I think we need to recognize that our macroeconomic fundamentals in terms of the Indian macroeconomic fundamentals are in pretty good shape, right? All the numbers, whether it's the growth number, inflation, policy rate setting, trajectory of the current account deficit, trajectory of the fiscal balance, all moving sort of directionally in a way that we would like it to go. And I think that's, giving a fair bit of stability to the Indian economy. And to be very fair, Latha, this is actually true of many of the emerging economies at this point of time. Maybe not the really, low income countries, but many of the classical EMs are not experiencing the kind of pain that they have in the past when the Fed hikes rates. So this is the reality of India. We are in much better shape to tackle this rise in rates. But if you think about it, there are two issues we need to worry about. One is that, when we talk about valuing equities, we are essentially valuing the cash flows which accrue to the enterprise over a period of time. Now, what rate do we use to discount those cash flows which will accrue to the business over the next 10 years, 20 years, 30 years? we essentially use some sort of a long-term interest rate to do that. So in the US, maybe you'd use the 10-year bond. In India, you'd use the 10-year bond. Now, the minute you start to say that the US bond is going to be higher for longer, then, the sort of P multiple, which is a derived number once you figure out the present value of the cash flow, will come down. This is pretty much the inverse of the commentary that we heard over the last 10 years, which is PE multiples can be higher because interest rates are lower. Now we are reversing the paradigm from the looks of it, and if therefore interest rates are going to be significantly higher, those PE multiples need to start coming down. To some extent, this would also be true of India, because even though our fundamentals are in reasonably good shape, you would have to worry about the carry between your interest rate and where the US is. At the margin, we continue to want to attract capital into India, and therefore there is a need to sort of monitor where your rate is pegged relative to the US. So I think a more significant downdraft for valuations in the US, but certainly some of that pressure will translate into a downdraft for valuations in India as well. And it's just the mathematics of thinking through how we value an enterprise, which is the value of cash flows accruing to the company.
Okay. Well, actually, I'm going to upgrade a question I was going to ask later on in the show. This PE, how are the current multiples looking? We were just running the Motilal Oswal numbers because that's what I had handy. EPS growth for the quarter gone by, they say, is actually better than expected. Nifty EPS came in at 32%. They were expecting 25%. Overall, therefore, you think valuations at 18.5 times 1 year forward is good? It's, I believe, 8% discount to the long-term average.
Well, depends on where you look at it, Latha. So just two things. First of all, no point looking at quarter and then doing the year-on-year comparison, because remember, this was the quarter last year which got badly disrupted because of the whole Russia-Ukraine conflict. So the year-on-year is quite meaningless. The full year forecast is that the growth will stabilize at about 18%. That's the Bloomberg consensus number for March 24. But, I still think there are some downside risks to that. And those risks are essentially coming from the fact that, growth is not gangbusters, whether it is for economies which are globally facing. And even in the local market, what we're increasingly seeing is that a lot of the consumption-oriented areas, the outlook is good, but it's not great. So I think there are some challenges in terms of delivering this, strong profit growth. But to be fair, some of this profit growth is a function of margin normalization. And, that's really what's supporting that. But I think you need to step back and look at the bigger picture, right? Because valuations, when I look at it compared to, let's say, a 20-year average, are much higher. They're almost 20% higher, 15 to 20% higher than the long-term average over the last 20 years. Now, when you look at the last 10 years, Latha, remember that those multiples were pushed higher simply because rates in India and across the world were much lower during that period. Now, if we are arguing that rates are going to be higher, both globally as well as in India, because you can't afford to cut your rates too much if the US is willing to pay more, then, I think it's better you look at that 20-year P multiple. And on that number, I think we are still at a little bit of a premium. Finally, one point I will make, Latha, when you look at the really long term in India, right? So we were looking at the data for the 20 years ended, March 2023. Over this entire 20-year period, the Nifty 50 EPS growth is about 12%, right? And that's a 20-year number. Now, to my mind, I would be, I'm willing to have a base case that the next 20 years could be 12% earnings growth, but it's very hard to see how you can do significantly better than that in an economy where policymakers are increasingly saying inflation is important to us, we want inflation at 4%, that's our target. So, your whole policy matrix is perhaps geared to nominal GDP growth of 10 to 11, maybe max 12%. It's very hard for, EPS then to grow consistently above that level. Then when you look at the valuations, I think there is certainly a challenge.
Okay. Yeah, and to be fair, global growth also may not be what it was in the last 20 years. The world is also slowing. But just very quickly, one rebuttal for what you're saying. Haven't we had a paradigm shift in financialization? A wall of money apparently is coming to equities through mutual funds. So that might still keep valuations high?
It could, but I don't think that's a good reason for them to be high, because as I said, value of the company is a cash flow, and you can't really just use the demand supply equation of money to determine that. One final point, Latha, because we shouldn't get too ahead of ourselves. Keep in mind that some of this is all evolving, right? Because we've got a democratic government in the US. We are talking about elevated fiscal. Who knows if there's a regime change and you go back to Republicans and conservative. So there are lots of moving parts over here. We can't get ahead of ourselves and say for sure we know what will happen in the next 10 years or for that matter 20 years.
No, I agree. Market discussions are always time-bound and perishable. Vetri, I'm being warned I'm out of time, so I'm not able to ask you some of my more favorite questions. So I'll get the viewers' favorite. What would you stay with now? Is it still financials? Is it consumer goods, consumer discretionaries? That seems to be everyone's favorite.
Yeah, so I think the financials we still like. I think there's been a massive consolidation which has happened within the banking sector. So, we still like that area. The numbers are quite strong. I also won't be surprised if credit growth surprises to a little bit to the upside, simply because I think everybody who's borrowed offshore money in the last decade because offshore money was cheap is now trying to figure out how do I convert back into rupee borrowings. I don't want dollar-denominated borrowings. So I think overall outlook for credit growth, very marginal, but it will all get supported by this as well. So that's an area we continue to like, though I would say valuations over there are honestly more mid-cycle. I know the ROAs are extremely high, but keep in mind these credit costs will not sustain through an entire cycle, right? So we need to keep that caveat in mind. Pharmaceuticals, healthcare, we think is perhaps one of the still slightly contrarian opportunities. It was maybe more contrarian 6 months ago, but I still think there's some valuation comfort there. Autos, we still think has a little bit of cyclical growth upside, though again, I think valuations are sort of now pretty much cycle level averages.
Okay, very quickly then, what do you make of the mid-cap rally now? That's where we are at all-time highs.
Good question, Latha. Honestly, I'm blown away by the strength in the mid caps and small caps. It's been phenomenal, but I am very concerned from a valuation perspective, particularly in the small caps. I think over there, some of the points you made about that wall of money is a cause for concern. Just like when we say stocks can get trashed to meaningless valuations on the downside because somebody is selling leverage positions, valuations can get pushed to absurd levels because of this wall of money trying to get into part of the market which doesn't have natural liquidity to that extent. So I am concerned about valuations, particularly in the small cap space, slightly less in mid cap, but I think both these areas, I would say to my mind, I would rather go to the comfort of large caps today than towards the mid and small.
Oh, that's very useful advice, Vetri. Thank you very much indeed. Someone before you was just consoling himself that at least the very, very bad small caps have still not started moving. So maybe we are not still in that bubble territory. Pleasure speaking with you. Thank you very much. We have to wrap up on Bazaar. On that note, Chartbusters up.